What's up, traders? Which Ichimoku settings are better for cryptocurrencies? I'm going to try to answer that question in this video with a data driven approach. So, what are we talking about? Ichimoku is an indicator set available on pretty much every platform that looks a little something like this. It's well defined by the cloud and different lines. These are not moving averages, but the number that these lines are based on are how you set up the indicator. Basically, like so. You go into the inputs, and the classic settings are going to be 9, 26, 52, 26. In the cryptocurrency world, there is the notion that there are better numbers that are more appropriate for cryptocurrency. And those are going to be the numbers 30, 60, 120, and 30. That's the debate. And really, if you switch between the two, the difference is subtle, but the justification of the new numbers is that cryptocurrency is open 24 hours a day, every day of the month. And so the old numbers are not really appropriate. Well, I'm not going to take a side. I'm just going to present a little bit of research and you can decide for yourself. So let's take a look at that. So I decided to go through a data driven approach on this. And fortunately, we have 10 years worth of Bitcoin price action to work with. So, a little bit of history first. Ichimoku was invented by a Japanese newspaper writer, Gosha Hasada. Hope I don't butcher his name. Right around the time of the 1930s, so almost 100 years ago. And it's been used in all markets from rice futures, which was the original reason he used to publish it in newspapers back in the mid century, all the way to today, where it's used to trade the stock market, futures, and crypto. More recently, the numbers have been proposed that are better for Ichimoku. Traders have been modifying these numbers since 2013, as long as Bitcoin's been traded. I did a little bit of research to try to find the origination of these. And, the early alternative was to round things up to 10, 30, 60, 30. And then that evolved into the current iteration, which I'll credit with the YouTuber Josh Olwas Olzu. Sorry, Josh O. I don't know how to pronounce your last name, but that's the debate. And this has been adopted by much of the cryptocurrency scene as the better alternative. Well, let's do a comparison in the context of a strategy. So, again, the debate is between legacy settings, cryptocurrency settings, and what about those people that say technical analysis is just astrology for guys? Well, there's, of course, just buying and holding and not worrying about trading back and forth. So we're gonna take a look at that as well. So let's do a back test. Here's what this is going to look like. This is a strategy that I use and I really believe in, which is a confirmed Ichimoku Cloud Breakout. What you have is price when it gets outside of the cloud. It starts back here, gets out, but what you want to wait for is the lagging span or Chikao to get out of the cloud, get clear as well. And this is the confirmation for the breakout. So that is what a bullish breakout would look like in Ichimoku. So this is the methodology for the backtest. So for both settings, I'm going to use the bullish confirmed cloud breakout to go long, the bearish confirmed cloud breakout to close it. We're not going to take any shorts. And we're going to start a little late. We're going to assume that we got into Bitcoin late, only 2012, with just $10 invested. Now for the HODL, we're just going to buy $10 worth of Bitcoin on 420 2012. And I went ahead and threw out the 2011 signal, the first time you could have possibly bought it based on this signal at 13 cents, because that's going to throw off the returns. But of note, the legacy cryptocurrency numbers would have returned about 7,000% when they exited at $9.26. And the new and improved, which actually hadn't been invented yet in 2012, would have returned 5,900% at 7.8. So we're going to throw that out because it wasn't even invented yet. Now, These are the trades that the strategy took for the Ichimoku legacy. Now, if you want to pause and take a look at this and double check me, pretty sure this is right. We have the date that it was taken, the entry point. These are all based on daily closes, by the way. We're not trying to get fancy with any additional technical analysis. And the date closed, the exit price, number of days that it was open, the change. These are all in dollars, by the way, and the return. And you can see over the years, over the last 10 years, this is what it has basically returned. Your $10 invested on May the 6th, 2012 would now be worth $133,000. Pretty good return. This is using the cryptocurrency numbers for Ichimoku. Now, there's a lot less trades, and I'm going to go into why that is shortly. And this is the return from $10 starting on April the 20th, 2012, all the way up to in December, where the last exit signal fired, just like the last exit signal fired for the original one, a few days close to that. So that's the trades for the cryptocurrency system. Here's the P&L just in real terms. And so if you'd invested $10 back at the first trade, 420 back in 2012, the legacy Ichimoku settings would be sitting at a profit, a return of 133,000, almost $134,000. Pretty good. Buy and hold, not taking any strategies, would have yielded about $80,000. And the Ichimoku crypto settings are lagging, only return about 60,000. So it's actually not beating the HODL. Now, let's visualize this a little bit differently. Let's use what we need to use in all cases, a logarithmic chart. And so this is going to show the returns over the last 10 years logarithmically. And there's something we can notice here. The returns do not stay consistent. In fact, HODL at many times here, the 2018 run, it has actually outperformed both of these strategies. And the Ichimoku crypto settings, funny enough, after they were invented in 2016, had outperformance in the 2018 cycle and the 2020 cycle, but then began to lag really only least recently. In fact, the legacy settings also has had some outperformance and underperformance, and only now it's leading. So there's a big difference in the real returns. But if we look at this, there's nothing really consistently different. There's no consistent winner over the last 10 years. So that leaves us to make a very honest assessment of both the different strategies and hodling. There's really no clear winner. I mean, it's in a bull market, everyone's a genius. And so if you bought Bitcoin, you're a winner either way. But there's no conclusive way to say that one is better than the other. So now let's go into the philosophy of things. I don't believe that any one particular setting is better than another. I think that consistency in applying one set teaches your brain the pattern recognition to recognize opportunity, and then it's up to your risk management to make them work for you. But let's look at some of the key differences between the two numbers. The numbers for the improved cryptocurrency are almost double. We go from 9 to 30, and then from 26 to 60, and then 52 to 120. What that basically has the effect of doing is extending out the signals. Let's see how this works if we just do by comparison. So in this bullish trend here, they got in roughly about the same time, but you had an exit signal on the legacy sit numbers, but then it got you back in here. So you're going to take, that's where the more trades comes from. You're going to take more trades because the lower the numbers, the more signals it's going to generate. Whereas the improved cryptocurrency would have kept you in the trade longer, but it also got you out later. So that's the trade off. In this bullish run right here, it got you into the trade sooner and out of the trade sooner, whereas the improved got you into the trade later and out of the trade later. So there's a big difference in performance right there between the red, which is the legacy settings, and the blue, which is the cryptocurrency settings. On the flip side, again, we see where the legacy settings got us into the trade back in March of 2019 earlier, got us out earlier, whereas the cryptocurrency settings got us in later and got us out later. But as I said, the flip side is you oftentimes have more false signals. In other words, this got you out here on this dip back in July of 2017, got you back in later, but you missed out on a good 30% of returns in here because of that signal, whereas the cryptocurrency settings kept you in the trade longer. A few other divergences, you had a false breakout here, which the legacy settings didn't, excuse me, the cryptocurrency settings did not get you into. But oftentimes they would be virtually the same entry, virtually the same exit as well. So that's really the difference. What ends up happening is you have a signal happen in a lower number first than it would a higher number because it's looking at a longer timeline. And that's really the trade off. But again, I can't say conclusively one way or another using this back test that one is better than the other. So, whichever one you like, whichever cool story, bro, that you want to believe is better, go for it and trade wisely. We'll see you in the next video.